volatility here lately in the markets. And in fact, with the tariffs, a lot of things have been thrown at these markets. So we want to just take a minute and compare what the grains have done since the beginning of the year compared to, say, equities or crude. The other thing is we just want to show 4 different strategies on how to get long the market, just in case you happen to have a bullish bias, towards doing something in that direction. At the end of the day, make sure that you guys know and understand your own risk tolerance, and keep in mind everything we're discussing is for education and example purposes. Like I said, it's been a little bit of a rocky road in here lately. We've had some pretty hard drawdowns in the equity markets. Tariffs have been ratcheted up, especially between the US and China. The US has about 104% tariff now on Chinese goods, I believe. And I think China has escalated somewhere into the 80% range, if that's, fairly close. But what we want to do is just kind of take a look at how well the grain futures have held up since the first of the year, considering all of this news. So when you look at front month corn, for example, that's up about 2.85% since January. Front month beans are relatively unchanged. And then Chicago wheat's down about 2%. Contrast that with what the equity markets have done since the beginning of the year. When you're looking at front month futures, the mini S&P 500 down about 15%. The Nasdaq E-mini is down about 17, nearly 18%. When you look at the Dow mini, that's down about 11%, 11.5%, and then crude's down nearly 21%. So all things considered, when you look at what's been thrown at this grain market, things have held together pretty well. Going over to the long futures strategies here real quick, we've got 4 strategies that we want to highlight: buying a futures contract outright, buying a call option, and then selling a call option, known as a bull call spread, as well as selling a put and buying 2 calls with the intent of using that sold put to help finance some of that position. As always, we want to start out with our risk and what are you comfortable with? That's the number one question to ask yourself before you consider any sort of long strategy. Do you want a penny for penny move? Are you looking for more of a fixed risk position? Are you looking at more of a fixed risk position but with less cost? Are you looking at less cost with a little more risk but potentially more upside? So when we jump over here, we're going to use Chicago wheat for an example. And keep in mind, we're not making any specific recommendations here. We're just talking in example terms. But if you wanted to buy a July Chicago wheat contract outright, you're looking at 5,000 bushels. You're going to have an initial margin of about $16.50. And let's just say we're going to use a stop loss of about 20 cents. That's going to be our risk. Now, keep in mind, if you don't have any sort of stop loss parameters in place, your risk is potentially unlimited, or as far down as this contract wants to go. But in this instance, we're going to use 20 cents. So our potential risk on this position is $26.50. Our upside, therefore, is unknown. This is a type of position that's going to move penny for penny, whether you're right or wrong. On the daily Chicago wheat chart, we just wanted to highlight what that looks like if you were to enter somewhere around that 550 area, and then you'd have your stop loss somewhere in the 530 zone. Going at an at the money call strategy, a little bit different. You're likely not going to get that penny for penny move, but for the trade-off for that is you are going to get some fixed risk. So if you were to look at an at the money call option for July Chicago wheat, you spend roughly around 30 cents or about $1,500 when it comes to option premium. Your potential risk, therefore, is that 30 cents or $1,500. Your upside then becomes unknown, less your 30 cents. So again, flipping back over to that daily July Chicago wheat chart, you can see if you were to get long somewhere around 550, your downside risk there brings you to around 520. And then your upside potential is whatever the market gives you, less that 30 cents in option premium that you paid. Another example, if you're looking at calls, but you think that they're a little bit too expensive, but still want to have that bullish bias, is considering a bull call spread. This is where you're buying a call, preferably something at the money, and then selling an out of the money call against it to help finance. We like working with round numbers. So if we get long a call, it costs us 30 cents. And we simultaneously sell a call and collect 15 cents. That's going to bring our net cost to this entire position to 15 cents. Also going to fix our risk to that same 15 cents, or about $750. Now, keep in mind, though, when you sell that call, you are putting a ceiling or a maximum potential on this market. In this case, you're limiting yourself to an upside of 35 cents or about $1,750. Again, here it is on that chart. So we look at that long call around a 550s area. We have a max loss sitting down there 15 cents below at about 535. We're selling a $6 call to help finance. That's going to cap our max gain somewhere in that 585 range. Lastly, another a little bit more sophisticated strategy that you could consider is selling a put and buying two calls. Here again, what you're trying to do with that sold put is collect the call premium in order to help offset some of the cost for buying the calls. So if we were to buy two 550 calls for around 30 cents, we sell, let's say, like a 520 put to bring in 15 cents, we've now reduced our net cost to 15. The whole theory behind this is if the market goes higher, that option on the put side is going to lose value. Your call options are going to gain. You can exit one of each simultaneously and then hold that last call to see what the market's going to give you. But now keep in mind when you are selling that put, you are putting yourself at risk of margin calls and potentially some significant downside. So where you have fixed risk with a call spread or an outright call, you don't have that same fixed risk parameters here when you're selling that put. So just keep that in mind. At the end of the day, your upside is generally unknown, give or take, less that 15 cents that you spent. So here it is again on that chart, same 550 buy area with two calls this time, and then selling a put somewhere down around 520 to pick up that 15 cents. So to finish things up in here, a couple points that we really want to make. First of all, we need to just take a step back, and I think we got to point out that the gray markets have held up relatively well, especially when you compare it to the equity markets and even crude oil. It just goes to show that people need to eat and that we are trading physical commodities, and the fact that we still have some U.S. weather in the second half of South America's growing season, especially for corn to get through, and that is kind of helping hold this market together. It's not to diminish trade or the tariff wars, but at the end of the day, we do have to like that these gray markets have held together relatively well. Now, when we look at long positions, of course, we always have to start with what is your risk tolerance. Are you looking for something that's fixed risk where you know upfront what your maximum loss is? Or are you willing to take a little bit more risk for potentially better rewards? That's generally what these trade offs come to, and it's ultimately your choice to make that decision. Lastly, what type of move are you trying to capture? Are you looking to capture that 10-cent move and be on board penny for penny, regardless of direction? Or are you just trying to set yourself up for something that's a little bit more of an outlier, or let's say a breakout move out of a broader range where you're okay giving up that first maybe 15 or 20 cents, but you want to be on board for a much bigger move? So that'll kind of help you roadmap, what direction you'd like to pick or what strategy might make better sense for you and your own risk tolerance. As always, if you have any questions, feel free to reach out to us. We're always more than happy to help. Make sure you guys hit the like button, subscribe to the channel. We always enjoy making this content for you.